For more on what the Fed's next move means for equity investors, let's bring in Crossmark Global Investment CIO Bob Dahl. Bob, I want to get your reaction to what Steve just said there. Is that your sense, too, that the market is looking, at least the equity market is looking for kind of any reason or any sort of little inklings from the Fed and from Powell later today to springboard from?
No question the market seems to want to go higher. As Steve said, that's part of the year-end seasonal strength. But look at yesterday. I mean, after we got the CPI number, it looked like we solved the cancer problem in the world. The market just took off, gave most of it back, and the underlying technicals were not great. So I think the market is tired. It's gone up a lot in a short period of time. And yes, the Fed matters. Chair Powell has to come out and say, we're making some progress, but he also has to come out and say, but it's 7.1 on a trailing 12, no longer 7.3. That's progress in the right direction, but it's a long way from 2, Morgan.
That's right. So it raises the question, is the narrative changing? What does and what I mean by that is, from an investor standpoint, is it changing from one about concerns about inflation to ones now about the possibility of an earnings recession or even an economic recession next year? So not so much what the Fed's going to do, but what the Fed has already done.
Yeah, so this now depends on what the Fed really wants. If they insist on 2, my view is they have a lot of work to do, and we will not avoid a recession. Conversely, if they quietly say, maybe 3's okay and 4's close enough to 3 and they acquiesce, well, then maybe we get a soft landing. So there's a lot of work to do and a lot of language to speak over the next few months for the market to figure it out. Either way, earnings estimates, I think, are too high.
Are you a believer, Bob, long-term, that they do sort of readjust their target higher than 2? Olivier Blanchard wrote a piece about that in the FT earlier in the week. And what's the impact on the dollar if, in fact, they went that way?
Carl, I think you're right. I think that the 2 world that we had for some time, as inflation was really 0 to 2, is now changed. Service inflation, the wage picture we talked about, the decline in globalization, all of that points to we're not going to be at 2. 3 is probably more realistic, which obviously does have implications for the dollar, of course, depending what other central banks do as well. I think it also has implications for the multiple on the market. I'm not sure an 18 PE is consistent with 3 in inflation if that's where the Fed ends up going.
That's right. And it's probably not consistent if history is any indicator if we were to go into a recession, whatever that recession looks like either, from a valuation standpoint, which raises the question, Bob, what does an investor do here right now? Do you take some money off the table in light of the recent rally we see? Do you put money to work in certain, value-oriented opportunities, something else? What do you do right now?
Well, consistent with what we've been trying to say for most of the year, at least the second half, buy the dips, trim the rallies. We've had a rally. I'm not against doing some trimming, having a little more defensiveness in the portfolio, seeing what next year's earnings levels are going to bring. So I'd be a little on the cautious side here in the 4,000s.